Good evening, friends. Welcome to the latest edition of Passive Speak. In today's edition, we will be covering a new fund offer, HDFC Nifty India Consumption Index Fund. Uh, as the name suggests, this fund will be tracking the Nifty India Consumption Index. As you know, India is a very popular global story on consumption because of its demographics, because of the rising power of our GDP, because of the rising per capita income of our population. So these are the factors which are driving the consumption theme in India. It has been a theme which has been around for quite some time. But where are we today? Today, India's consumption is at an inflection point. We have seen in the past examples like China, when the per capita GDP crosses the capita income crosses the $2,000 mark. That's when there is an inflection point in the consumption of the general public. India has crossed this $2,000 mark, and generally, what we have seen even in the US, when between the two to $4,000 per capita income, that's when the consumption theme takes off in a very big way. Secondly, India has a big demographic dividend, as everyone knows. It is one of the largest countries by population and also the youngest in a world where there is a declining dependency ratio. Uh, Thirdly, there is another theme called premiumization, where as the income rises for the average person and there's higher disposable income, then the people tend to buy goods which are at a premium or premium goods. The other factor which is driving consumption is the formalization. There's a lot of shift we have seen with the advent of digitization, popularization of UPI, which was all triggered by demonetization, the introduction of GST, and the corporate tax cuts also, which were initiated by the government of India. Now, this has prompted a shift of business from the unorganized to the organized sectors. So we have a lot of business which is now coming into the organized sector of the economy, and this is leading to an increase in the overall consumption. The other factor which is kind of hastening this trend is digitization. So the consumption landscape is changing with improved access to products and services through the smartphone, through the UPI payment mechanism. So you see a lot of consumption now is the patterns are changing where people don't need to leave their house in case they want to consume any goods or services. So if you look at this chart, uh, the food and non-alcoholic beverages as a percentage is coming down, and private final consumption is the non-food part that is there that is going up, and this is thanks to the steadily rising per capita income. So food, which used to be a big uh, part of the overall consumption basket, is now reducing in size, and more discretionary spending is coming in through on the private consumption side. And this is a result of the rising Indian per capita GDP. Now, if one looks at the various categories where the consumption happens, so you can look at the chart that the highest spend is on health in terms of this last 10-year period of FY14 to FY24. The fastest, the greatest increase in the spending has been on health, followed by transportation, then communication, then restaurants and hotels, and then education. So if you see food and non-alcoholic beverages has come down quite a bit. It's just the fourth largest in the terms of the categories in which the spend is happening. And this increased spending across so many categories, which means across many listed companies, across sectors, will benefit the long-term potential of this consumption theme. So there is broad-based consumption across sectors, across categories, which is represented by the various companies which are listed on the exchanges. So there are these measures which were taken by the government of India, which have kind of acted as a catalyst now to increase the consumption in the economy. One is the income tax relief, which was given in the last budget to boost the disposable income, where the exemption limit under the new tax regime was up to 12 lakh rupees. Thereafter, there was a GST rate rationalization, which was done to reduce the GST on the essential goods and to improve the affordability of the goods and services. So this also has given a big boost to consumption and is one of the driving forces of consumption going forward. Thirdly, RBI has also acted in tandem with the government to prop up the growth rates in the economy by virtue of having a series of rate cuts of 125 basis points so that the loans become cheaper and the transmission of the lower rates happens over time, and this could lead to increase in discretionary spending. The other factors which have boosted the purchasing power of consumers is a good monsoon and lower inflation. The food inflation has come off quite a bit, and this is reflected in the CPI numbers, where the inflation is much below the concern rates for RBI, and hence they took the decision to cut rates. So, a virtuous cycle has been unleashed by the government with all these measures, both on the fiscal side and on the monetary side, and coupled with good monsoon and benign food prices. This has acted as a recipe for increased consumption over time. So, if you can see this chart, we have shown that the consumption stimulus totally is aggregating to 11.7 lakh crores. And this, as a stimulus, consumption stimulus as a percentage of GDP, is totaling up to 3.6%, which is comprising of the GST tax rate cut savings, the income tax savings, the repo rate related savings, and the welfare schemes, and the hike in the eighth pay commission. So there's a strong policy push to benefit the consumption theme amid uncertain external environment. As you know, the global environment has become very uncertain with the advent of the US president and the introduction of tariffs across countries. So this slide, we cover a bit on the GST rationalization, which has been a major boost for consumption. So the rationalization has resulted in discontinuation of the 12% and 28% slabs. There are two primary rates of 5% and 18%. And for the sin or demerit goods, there is a rate of 40%. Many consumption sectors have benefited from these tax cuts, including automobiles, FMCG, and consumer durables. The total GST which is foregone as a result of these cuts was totaling up to 1.8 lakh crore, which translates into 0.5% of the GDP for the government. Uh, so the key sector implications of these cuts: small cars and two-wheelers, where the GST rate has been cut down from 28% to 18%; tractors, where the GST has come down from 12% to 5%; auto components, most of them have moved from the 28% bracket to the 18% GST bracket. And for consumer staples, almost all food items and select essential personal care categories, the rate has been rationalized from 12 to 18% to 5%. Inflation, as you can see, this chart has slowed down quite dramatically. Food inflation has been benign. The core inflation of food and fuel has also been benign. That has led to a durable reduction in the inflation rate overall. And this has helped RBI to initiate the rate cuts to boost the economy, which had shown some signs of slowing down in the last quarter of the financial year 24-25. So our product is based on the Nifty India Consumption Index. It offers a comprehensive exposure to India's consumption theme. This will be a passively managed strategy. The fund will essentially replicate the Nifty India Consumption Index. The parent index of this fund is the Nifty 500 index, and companies which are selected are those with a domestic operating revenue of more than 50% are considered for inclusion in this index. They are selected from various sectors like consumer non-durables, healthcare, auto, telecom, services, pharmaceuticals, hotels, media, and entertainment. The total number of stocks in this index are 30, and there is a upper cap of 10% based on the free float. The rebalancing of the weights happens on a quarterly basis in March, June, September, and December. And the portfolio is reviewed twice a year in March and September. If we look at the sectoral breakup for this index, the highest weightage is to the fast moving consumer goods or the FMCG sector, as it is popularly known. And if you compare this with the Nifty 50, there is an overweight of nearly 21%. The second largest sector in this fund is the automobile and auto component sector, which has a weightage of 26% as opposed to 7% in the Nifty. So there is an overweight of 19%. Consumer services and consumer durables are the third and fourth largest sectors in terms of the weightage at 13.4 and 10.8%. And in the Nifty 50, they just have 2.5% exposure each. So there is an overweight of 10.9 and 8.4% respectively. And even as you can see, for telecommunication, power services, there is an overweight, and then it starts having an equal weight with the Nifty 50 in healthcare and capital goods. If you look at the sectors where it has a least weightage, which are big overweights on the Nifty 50, it's financial services, where it's nearly 37% of the Nifty 50, and there's zero exposure in this index to that. Even to the oil and gas and consumable fuels and information technology in the Nifty 50, the weightage is 10.4%. There is zero weightage in this sector. So, as you can see from this chart, the sectoral allocation in the Nifty India Consumption Index is quite differentiated from the Nifty 50. Hence, you can see that the diversification from the Nifty 50 when invests in such a fund is very strong, and that can be a good point for asset allocation to such a product in your portfolio. So the exposure to leading companies is one of the driving factors for the consumption themes. So the top 10 constituents, if you look at them, the companies are amongst the leading companies in their sector. If you look at the current allocation of the top 10 constituents, there's Bharti Airtel, ITC, Mahindra and Mahindra, Maruti Suzuki, Hindustan Unilever, Eternal, Titan Company, Asian Paints, Interglobe Aviation, Bajaj Auto. If you make a comparison on the fundamental valuation parameters, the P ratio for this index is much higher than the Nifty 50 index at 41 times versus 22.75 times. The price to book is also at 8.3 times as compared to 3.55 times in the Nifty 50. The dividend yield is also lower at 1.05 versus 1.28. But all these parameters are higher because of the superior return on equity, which is offered by these companies in this index, which is at 21.8% as compared to 16.39% in the Nifty 50 index. So here the companies are high quality companies, hence they demand premium valuation, and hence on the fundamental uh, parameters, the index looks of higher valuation in comparison with the Nifty 50 index. Okay, now I'll hand over the presentation to my colleague Shikhar. He will take this forward.
Thanks, Sandeep. So I'll just cover the return section. So one thing to note is this is an important point that the index has outperformed the Nifty 50 over long-term horizons. So in the last 1 year or so, it's narrowly underperformed. So it's given about a 9.2% return versus 11.9% for the Nifty 50. But if you look at 3 year, 5 year, 10 year, and even since inception, there is an alpha of anywhere between 2 to 4 percentage points, right? So what this is showing is that obviously the index is made up of many different sectors. When some sectors are doing well, others may not be doing so well. So in effect, it is very much a diversified product focused on the consumption theme. So you're seeing that over the long term, this has borne fruit. And many of the points that Sandeep had described earlier in the presentation about the long-term drivers, they have fueled the consumption sort of story that we've seen over the last 10, 20 years, and many of those drivers are still valid going into the future, right? So this kind of medium to long-term outperformance is definitely an important aspect of the product. Second point to just sort of highlight, we've also shown the performance of the consumption index versus the benchmark, or not the benchmark, but versus the Nifty 50. Reason we've chosen Nifty 50 is that a lot of the constituents, so almost 96% of the weight of the consumption index is indeed large cap. So Nifty 50 is a good, sort of almost a like for like comparison. And not only, as we showed in the previous slide, as the consumption index outperformed the Nifty 50 over the long term, but even on a financial year basis, you're seeing that out of the last 20 financial years, in 12 of those, so that's almost 60% of the time, the consumption index has outperformed the Nifty 50. So you can see, and when this outperformance has come, so it was a lot of the outperformance came during FY12 to FY16. So this was a period, at least from FY12 to 13 and 14, where India was experiencing a little bit of fragile macro, and the external conditions were quite difficult. So that was a time where the India Consumption Index, because it was focused on local consumption, it actually did better than the Nifty 50. Even during the 2008-9 financial crisis, you had the consumption index doing better than the Nifty 50. And recently, after you've had this the sort of post COVID era, again the consumption index has been doing well because of primarily due to its exposure to telecom, consumer services, and autos. So point is that like we mentioned earlier, sometimes when India did suffer from a difficult external environment, as we are facing right now, in the past we've seen the consumption index do well, and even in the last few, this FY and the previous FY, the consumption index has done well in spite of us facing a similar difficult external background. So this is the performance by FY. And lastly, we come to the rolling returns, right? So this is kind of giving you an idea of the consistency of this index versus the Nifty 50. And what we can see is that over 1, 3, 5, 10 year, all these periods, the Nifty India Consumption Index has given you a higher average rolling return than the Nifty 50, right? So, for example, over rolling 5 year periods from 2006 onwards, the consumption index has given you around a 14.4% CAGR versus 12.2% CAGR for the Nifty 50. So, on average, you've got almost 2.2% worth of alpha, on a rolling 5 year basis in terms of returns. Even if we look at the volatility, it's quite interesting that despite having just 30 stocks in the index, the consumption index has been quite well behaved in terms of its standard deviation. So, over 1 year, for example, rolling 1 year periods, the standard deviation is 17.5% compared to 22.2. And even over longer term periods, right, like 5 year periods, and so on and so forth, the rolling return differential is the standard deviation differential is extremely minimal. So you have the consumption index in effect over the long term, giving you a higher rolling returns on average with almost comparable, if not lower levels of volatility than the Nifty 50. So this is a very sort of interesting return risk index, and that's why we've decided to go ahead with it. In addition to the, as Sandeep mentioned earlier, that the difficulties that we are facing externally can somewhat be offset by the government policy push internally. So with that, I'll conclude and hand it back to Sandeep to summarize and take you through the fun facts and the disclaimers. Thank you.
Thanks, Shikhar. So, what are the key reasons why should one invest in the Nifty India Consumption Index Fund? There has been a push by the government, which is set to benefit the consumption theme. All these measures have been taken into account, keeping in mind that there is an uncertain external environment globally, which can be seen after the so-called tariffs were unleashed by the US government with all their various countries who are their trading partners, including India. So these measures have been taken by the government to kind of uh, increase the consumption domestically so that we can buffer any shocks which might be coming from the external environment. The exposure to leading companies is driving the consumption theme. So, as we saw in the previous slides, most of these companies in the consumption theme are the largest in their segments in the industry, and these are the companies which are driving this consumption theme. If we look at the return slides, which Shikhar had just covered a couple of slides earlier, if you look at either the historical performance, there has been a long-term outperformance of this theme, the Nifty India Consumption TRI versus the Nifty 50. So this is a product which is differentiated from the Nifty 50 in the sectoral allocation, and also a sector which we have seen where the standard deviation is not as high as Nifty 50, and which can generate some alpha over the long term because of the underlying fundamentals of the Indian economy, the Indian demographic, which is supporting the continued consumption story in India. And as we saw that beyond a certain per capita income, there is an inflection point in the consumption, and that's where this theme can play out very well uh, in the coming years. HDFC AMC has been in passives for a fairly long period of time. There are certain key strengths that they have. They've been managing index funds for over 20 years now. 19 ETFs, 27 index fund of fund. Thematic based, we have four ETFs and three index funds. We have on the smart beta side, five ETFs and six index funds. In the commodity space, we have two ETFs and two feeder funds. On the fixed income side, we have nine index funds and one ETF, and we have an international fund of fund. We also have leadership in some segments of the passive space. On the market cap basis, we have very large funds on the flagship blue chip indices like Nifty 50 and Sensex. We have one of the oldest gold commodity funds with over 15 years of history. We also have leadership in the small cap ETF categories. So when it comes to passives, HDFC has a very wide range of offerings with the desired experience and processes in place to manage these funds very efficiently. So just to recap, the HDFC Nifty India Consumption Index is a passive investment which will be replicating the Nifty India Consumption Index, the total return index, subject to the tracking errors. The fund managers are Nandita Menezes and Arun Agarwal. The benchmark is the Nifty India Consumption Index. There is no entry or exit load in this fund, and the minimum amount during NFO and on an ongoing basis will be rupees 100, and in multiples additional purchase will be 100 and any amount thereafter. And the allotment of units happens after deduction of the applicable stamp duty. As you can see, this is an equity-oriented fund, so 95 to 100% is what the allocation is to the constituents of the Nifty India Consumption Index. As per the riskometer, this product is flagged off as a very high risk product, and it is a passive investment vehicle. So that's it from our side. We can open for Q&A.
So one question is that how is this product or this index fund different from other consumption funds?
So, within consumption funds also, there would be different products. So, you have actively managed funds and you have passively managed funds. So, one of the key differentiators is that this is a passive offering. It is going to replicate the Nifty India Consumption Index. And to the extent if any other fund house is also replicating the same index, it would be a similar product. Definitely, but the advantage of this fund is that those who prefer a low cost vehicle and they want exposure to the consumption story in India, this is an ideal fund to take advantage of that space, and you get exposure to way. And this is, as we had covered, got a very differentiated sectoral exposure as compared to the commonly followed indices in India, where most of them have pretty large allocation to the financial services sector. And this product is giving you an overweight on FMCG, which is a sector which is not that loved anymore. It's an unloved sector because of relatively higher valuation. That sector has not been performing up to its optimum potential. So, from that perspective, you get exposure to such sectors in a fund like this. And from that point of view, it could be a great point to start your investments in the theme, which is very powerful, very durable for whatever reasons which we had enumerated in the slides, which at the cost of repetition is our demographics, per capita income, and the changing consumption patterns, which have been driven by formalization of the economy, the premiumization theme, as well as the digitization which has happened. So, all these themes are very powerful and they may not have played out that strongly, maybe in the recent past, but these are very secular themes. If there are structural changes in the way consumption patterns change in India and they replicate the patterns which now we see in developed economies, larger economies like us than China, like China and US. Uh, we see no reason why this fund should not do well with someone who has a long-term investment horizon.
One question is that given the recent trade deal between India and the EU, uh, is there any, what impact can it have on the auto sector? And any sort of, does that affect the expected returns of the scheme?
So generally, we don't give any calls on sectors specifically, but just to answer your question, there has been some uh, duty reduction which has been indicated as a result of the FTA between EU and India. And this is going to happen in a phased manner. Most likely, it is going to kick in from 2027. And this was for the cars which are completely made in EU and imported, and that's where the duties would be cut down over time. But the what the reports are given to understand is that the most popular cars from the EU which are being sold in India are the ones which are assembled in India, or they are called the completely knockdown kits. And here already the duty is 16.5%. So from that perspective, it may not make a material difference for majority of the cars which are imported and currently sold in India. The small cars have been kept out of the ambit of this duty cut, as the value indicated is 15,000 euros and above, which translates into 16 lakhs, plus if you take into account the registration and other taxes like GST, etc., it goes to 25 lakhs. So it the majority of the cars in India are of course the smaller two-wheeler, smaller cars, so they will not be impacted in a very big way. But it remains to be seen. I think what the government had communicated, that they had looked at the interests of automakers both in EU and India while rolling out these revised import duties, which will take time to kick into effect. And they do not see a very material impact on the auto sector, that the sales of domestic cars will go down dramatically as a result of these measures. So I think the auto story still is holds good. There could be pockets where those many cars are not manufactured currently by India, where there could be some duty relief. And government has also clarified that for 5 years they have kept electric vehicles outside the ambit of this FTA.
Okay. And I know you've already sort of mentioned it previously, but there's a more direct question, that how is the active, so the HDFC non-cyclical consumer fund different from this fund?
So I think that fund cannot strictly be compared to this fund, because there the fund manager is taking active calls. He need not replicate the underlying benchmark that he has to beat. And though the theme is also based on consumption, it is very different from this fund. There would be some sectoral overlap and some company overlap for sure, but this is a index-based product where we will be replicating the Nifty India Consumption Index, and that is our mandate, which is not the mandate for the non-cyclical consumption fund, where the fund manager is taking active calls and deciding the allocation to sectors and companies respectively, while doing his investment strategy.
Got it. Got it. And one more question, that do you have any preference or suggestion between a lump sum investment in this NFO or a SIP, STP?
The ideal way to invest in this fund, because it is these kind of themes can be decadal themes. So I think a SIP would be the most appropriate way of investing in these themes, because some of the companies get impacted by news flows. Like we had seen, ITC is one of the top 10 companies currently in the index. This stock was hit by the change in excise duty, which was announced by the government, and they had raised it significantly, and the stock price corrected significantly. And after the EU deal, there are certain auto stocks which in the last 2 days have corrected. So it's better that a person, as an investor, systematically invests every month in this theme for the next 5, 10 years, and I think then they would be major beneficiaries.
Okay. Then I see there's a question on, one second, how the stock weightages are decided and what is the portfolio review frequency. So we've covered that here in our methodology. So just to be clear, since this is a passively managed scheme, the fund manager will be replicating the Nifty India Consumption Index. This is an index which is launched and maintained by NSE Indices Limited. So in that, as per their index methodology, the weightage is free float based, which means that the larger free float market capitalization companies will get a higher weight. And the important point to note is that the maximum weight any one stock can have is 10%. So the reason for this is to prevent just one or two stocks from dominating the index, which is why you can see here in the last portfolio also that we have as of December 31st, the generally large market cap names like Bharti, ITC, Mahindra, Mahindra, those three, they were all around 10%, which is the maximum that one can go up to in this particular index. So that is the question on weightage. Second question is that why is the portfolio review done twice a year? So answer is that it's a sort of determined by the index methodology. As an AMC, we cannot do it on an ad hoc basis ourselves. But more importantly, the majority of broad market indices are done on a semi-annual basis. So if you look at your Nifty or Next 50, mid cap, small cap, any of these indices, and several sector indices as well, in many cases the review is done twice a year. So in order to keep it consistent, this consumption index portfolio review is also done semi-annually, and that too in March and September. So it coincides exactly with the rebalances or the portfolio reviews of the large cap indices like Nifty 50, mid, small cap, so on and so forth. Um, then there's a question: what would be the allocation of funds into sectors? So that we have mentioned here on slide 10. So it's, you can see that again as of December 31st, which is the last month end data we have, FMCG and auto were respectively 27.3 and 26.2%. So the weightages are for at the stock level are determined by your free float market cap and capped at 10%. Once the portfolio weights are determined, then you are able to get what these sector weights are. And that we can see that the sector is currently overweight FMCG and auto. Instead, it is underweight financial services and oil and gas. And in terms of, because it's a passively managed scheme, there's no active call, there's no fund manager saying that if the index has 27.3% of FMCG, he or she would take 35% exposure or 20% exposure. As and when the portfolio is reviewed, as and when the rebalances happen, as and when the weights change gradually, the scheme is just responsible for adapting and keeping in line with how the sector weights are evolving. So there is no active call taken by the fund manager to go higher or lower than the weights of the index. All the fund manager is doing is replicating the index, which means buying the same stocks and the same weights as the underlying index. Um, Sandeep, although it's not been mentioned, not been, mentioned in the presentation, could you just discuss the indicative TERs for this NFO?
Yeah, so we on the direct plan, we are going to be having an expense ratio of 35 bips plus the GST. And on the regular plan, it would be within that 1% ceiling. It would be around 85, 90 bips as per our estimates. On the regular plan, we have to take into account the eventual brokerage portion of the expense, and then that will decide the overall TER. As the name suggests of this fund, this is the HDFC Nifty India Consumption Index. Uh, this will replicate the Nifty India Consumption Index. This is a thematic index fund where consumption is the theme that we are focusing on. That is one of the most durable themes in India, as it is a very large population, a young population, and a population where the per capita income is growing, which can be evidenced in the overall GDP growth, where India ranks number 4 currently and is expected to become the third largest economy maybe in another 2, 3 years' time from now. And so this theme is going to be supported by these demographics. The pivot to premiumization and the digitization infrastructure which is there, that is also supportive of a long-term growth story for this consumption theme. The government, from time to time, has taken enough and more steps to boost consumption and help grow the economy at a faster trajectory. As you know, in this financial year, India is one of the fastest growing large economies in the world, and the measures taken by the government, whether it's on income tax, whether it's on GST, whether RBI's moves on the interest rates, all have been supportive of a very strong consumption rebound, wherein there was some evidence of a slowdown in the past. And this has also been aided by the lower food inflation and the normal monsoon, which helps the consumption in India. Also, as we have seen that in these 30 stocks, most of these stocks are leaders in their business segments. So you get exposure to leading companies when you are taking exposure to this theme. And we have seen whether on a rolling return basis, on a point-to-point basis, or even on a FI basis, the Nifty India Consumption Total Return Index has outperformed the Nifty 50 Total Return Index. So from that perspective, this is a great theme for diversification from most of the themes which are commonly followed as the exposure to the index heavyweights in terms of financial services or information technology or oil and gas is zero in this product, and it has got overweight to FMCG, auto, uh, and other sectors where the other indices don't have such a heavy weightage to this. So from that point of view, from a diversification perspective, this is a great product to add to your kitty, and it is ideally suited for someone to do an SIP or a STP into this product over a long period of time. And given the fact that it's an index fund, it is available at a low cost. There is no entry exit load, and I guess the NFO dates, this NFO opens on the 4th of Feb and it is open till the 13th of Feb. So do make the most of it, and depending upon your risk appetite and your overall equity asset allocation, this should be one of the good themes to consider for long-term investment.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.